Mastering credit spreads, boost your options trading strategy. Welcome back, fellow traders. In today's video, we'll dive deep into the fascinating world of credit spreads in the stock market options scene. Strap in and get ready to elevate your trading strategy. Let's start by understanding what a credit spread is. A credit spread is a type of options strategy where you simultaneously sell and buy options contracts, aiming to collect a net credit upfront. This strategy allows you to capitalize on the concept of time decay and market conditions while mitigating risk. Let's take a look at an example to illustrate how a credit spread works. Consider stock XYZ, currently trading at $100. You believe that XYZ's price will stay relatively stable over the next month, so you decide to implement a credit spread strategy. First, you sell an out-of-the-money call option with a strike price of $110, receiving a premium of $1.50. Simultaneously, you buy an even further out-of-the-money call option with a strike price of $120, paying a premium of 50 cents. The difference between the premiums collected and paid is your net credit, which, in this case, amounts to $1. So, what happens next? If XYZ's price remains below $110 at expiration, both options will expire worthless, allowing you to keep the entire credit. However, if XYZ's price rises above $110, the short call option may get assigned, and you'll be obligated to deliver the shares at the strike price of $110. But don't worry. Your risk is limited because you bought the $120 call option, which caps your potential loss. Now, let's discuss the potential benefits of credit spreads. Firstly, they allow you to generate income by collecting upfront credits. Secondly, credit spreads limit your risk exposure compared to trading options individually. Thirdly, they capitalize on time decay, as the value of the options you sold erodes over time. However, as with any strategy, there are also considerations and risks. It's important to manage position size and understand the potential maximum loss. You should also be aware of changes in market conditions, implied volatility, and upcoming events that may impact the underlying stock. To wrap it up, credit spreads can be a powerful tool in your options trading arsenal, providing you with a more controlled approach to generating income while managing risk. Remember, practice and experience are key to mastering this strategy. That's it for today's video on credit spreads. We hope you found this information valuable and can now confidently incorporate credit spreads into your trading repertoire. If you enjoyed this video, hit the like button and don't forget to subscribe for more exciting content. Happy trading, and we'll see you in the next video. If you liked this video, please give me a like and subscribe please. Thank you.